2 hours ago, the S&P 500 officially entered correction territory, down more than 10% from its February peak. Over $4 trillion in market value has evaporated in just 3 weeks. The Nasdaq is in free fall. The Russell 2000 is collapsing. And when asked if his tariff policies could cause a recession, Donald Trump refused to answer directly. Instead, he said, "China has a 100-year perspective. We have a quarter. You can't go by that. You have to do what's right." What he didn't say is more terrifying than what he did. On March 9, 2026, Trump sat for an interview with Fox News. The question was straightforward. Could your policies lead to a recession in the United States? Trump declined to say yes or no. Instead, he pivoted to China's long-term strategic planning. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters, and you can't go by that. You have to do what's right. The comment was framed as defending strategic patience. What it actually did was confirm what economists have been warning. Trump's tariff policies will cause short-term pain. Significant pain. Pain measured in quarters, not weeks. The markets heard that confirmation. On March 10th, the S&P 500 dropped 2.7%, its largest single-day decline of 2025. The Nasdaq fell 4%. Technology stocks led the sell-off as investors processed the implications of prolonged trade conflict. The next day, March 11th, the S&P 500 fell another 1.4%, pushing the index officially into correction territory. The benchmark index closed 10.1% below its February 19th record high. The Nasdaq 100 and Russell 2000 had already entered corrections earlier in the week. The velocity and scale of the decline is staggering. In 3 weeks, American equity markets lost over $4 trillion in value. For context, that's roughly the entire annual GDP of Germany. Wealth evaporated. Retirement accounts shrank. Pension funds took massive hits. The correction affects every American with exposure to equity markets: 401k holders, institutional investors, pension beneficiaries, mutual fund participants. This isn't just numbers on screens. It's real wealth destruction affecting millions of people. But before we break down what this means, if you find this analysis valuable, hit that subscribe button so you never miss coverage like this. What's driving the sell-off? Tariff uncertainty sits at the center. Trump's trade policies have created an environment where businesses cannot plan, investors cannot predict, and markets cannot price risk accurately. The Supreme Court struck down IEEPA tariffs as unconstitutional. Trump pivoted to Section 122 authority, creating new tariff structures. Congress is rebelling. The House voted against Canada tariffs with Republican defections. A federal judge ordered $200 billion in refunds. Trump announced he won't pay. Legal chaos compounds policy chaos. International trade relationships are fracturing. Canada's exports to the United States fell 5.8% as alternative markets absorbed Canadian goods. Mexico is exploring trade relationships beyond North America. China is positioning itself as a stable partner compared to American volatility. The post-World War II trade architecture built on American leadership and predictability is disintegrating. Markets don't know what comes next. Corporate earnings are taking direct hits. Ford suspended its 2025 financial guidance because tariff uncertainty makes forecasting impossible. GM warned tariff costs could reach $3.4 billion annually. Auto manufacturers can't plan production when input costs shift based on presidential posts and court rulings. The uncertainty premium, extra return investors' demand for unpredictability, is rising across sectors. The contrast with Canadian and Mexican markets is stark. While American indices collapsed into correction territory, Canada's S&P TSX remained stable, virtually unchanged from where it started 2025. Mexico's benchmark index, the Índice de Precios y Cotizaciones, actually rose 6% year-to-date through March. Canadian and Mexican markets aren't immune to North American trade disruption. But they've adapted. Canadian diversification into Asian and European markets provides cushion. Mexican manufacturing has proven resilient. And both countries benefit from being on the other side of American tariff chaos rather than causing it. American investors are noticing. Capital flows are shifting. British investment in Canada increased substantially in 2025, with over 40% of UK filings targeting Canadian software companies. Investors see Canada as a gateway to North American markets with less policy risk than direct American exposure. If American tariff policy remains chaotic and Canadian policy remains stable, that capital flow continues. The political implications are enormous. Trump enters 2026 midterms with markets in correction and recession warnings escalating. Democrats run on inflation and cost of living. Tariffs drive both. Consumer prices rise. Market corrections hit retirement savings. Republican candidates in border states face particular pressure. Auto workers in Michigan see layoffs. Steel workers in Pennsylvania see mills close. Farmers in Wisconsin see export markets disappear. These voters expected growth. They're getting contraction. House vote against Canada tariffs reflected this political reality. 6 Republicans defected to vote with Democrats. More would have defected if leadership hadn't applied intense pressure. The Senate passed similar anti-tariff legislation twice in 2025. Congressional Republicans are reading polls and hearing from constituents. Tariff policy is unpopular. Market corrections make it more unpopular. Recession would make it catastrophic politically. Trump's 100-year perspective comment suggests he understands this political risk, but has decided short-term pain is acceptable for long-term gain. The problem, he hasn't defined what the long-term gain is. Reshoring manufacturing takes years and requires massive infrastructure investment that isn't happening. Building alternative supply chains requires international cooperation that Trump's tariff policies undermine. Achieving Chinese-style industrial policy requires state capacity and political patience America doesn't have. What Trump is actually achieving is different. He's accelerating American isolation. Canada diversifies away, proven by 17.2% non-US export growth. Europe builds financial infrastructure bypassing American systems, proven by Canada, UK-EU emergency framework. China positions itself as stable alternative, proven by countries exploring Chinese trade relationships. The correction reflects investors pricing this reality. American dominance depended on being the most attractive destination, stable, predictable, rules-based. Trump's chaos undermines all three. Stability? Gone. Predictability? Gone. Rules-based? Gone, replaced by executive authority courts keep declaring unconstitutional. The Budget Lab at Yale University estimated Trump's tariffs would cost the typical American household about $1,200 in lost purchasing power. That estimate assumed tariffs remained stable enough to price accurately. With legal challenges, congressional resistance, and constant policy shifts, the actual cost is higher because uncertainty itself has economic costs. Businesses delay investments. Consumers delay purchases. Markets demand higher returns to compensate for risk. The timing of the correction matters politically. March 2026 is early enough in the election cycle that Trump could theoretically reverse course, moderate tariff policy, and hope markets recover before November. But reversal would require admitting the strategy failed. Trump's 100-year perspective comment suggests he won't do that. He's committed to the path regardless of short-term costs, which means the correction could deepen into a bear market. A bear market could trigger recession. Recession would devastate Republican electoral prospects. Trump's comment comparing American quarterly thinking to Chinese century-long planning reveals something important. He views himself as implementing fundamental restructuring that requires accepting short-term pain. But he hasn't built the political coalition necessary to sustain that pain. China's Communist Party can impose economic costs on its population without electoral consequences. American democracy can't. When voters feel economic pain, they vote out the politicians causing it. The midterm elections in November will test whether Trump can maintain congressional support for tariff policies during a market correction. Current polling suggests he can't. Pew Research found 60% of Americans disapprove of tariff increases. That was before the market correction. Post-correction polling will likely show even higher disapproval. Democrats need to flip only a handful of seats to take control of the House or Senate. Market corrections and recession fears help them do exactly that. Canadian and Mexican stability during American market chaos sends a message to international investors. North American trade opportunities exist without American policy risk. Invest in Canada to access COSMA benefits without Trump volatility. Invest in Mexico to benefit from nearshoring without tariff uncertainty. Both countries offer alternatives to direct American exposure. 2 hours ago, the S&P 500 entered correction territory. $4 trillion evaporated. Trump admitted his policies require accepting short-term economic pain for undefined long-term gain. Markets heard that admission and sold. The question now is whether the correction deepens into crisis, whether crisis triggers recession, and whether recession destroys Republican congressional majorities. Trump's 100-year perspective might require more political time than American democracy will give him.